Okay, so what I'm going to be doing is just going through a few statements from a company that just started trading for the purpose of preparing a cash flow and an income or aka profit and loss statement. I'm going to deal with a balance sheet in later examples, but for now the whole point is just to go through these 9 points in the bottom right hand of the screen. Just so you can see what the purpose, what the stages are to develop these two statements. So first thing is cash flow, and then the other thing is an income statement. There are two ways to do this. One is to go through each one of the 9 points and then go through them once for the cash flow and then do it again for the income statement. The problem is that it takes twice as long, and when you have to prepare the balance sheet as well, you'd have to do this a third time. So the real way to do it is to do it simultaneously. So what I do is that the cash flow is always generally the easiest thing to do. So just write out the kind of thing, the general formats, and because the cash flow is so easy, you can do it very, very easily like this. So you can say cash in, pound there, and for this column, what we're going to do, we're going to add up all the things, and then this column is going to be the sum total. So we'll be able to see what the sums are. So cash in, and it'll be something like boom, 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 and then we're going to put the total over here, and then we're going to do the cash out over here, boom, 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 and then the total of the cash out will go over here, and then we can say what the net cash flow is, which will just be the difference between cash in, take away cash out, and then we'll have net cash flow. Then we're going to add that to the opening balance, and that's we're going to end up with a closing balance over here. Okay, so we've set this out. It's really nice and easy, and that's done. That's really the hardest part, as is getting the format of the next one as well. So for the income statement or profit and loss statement, it always follows this this kind of format. So what I do, because it's a little bit of a longer format, I just write it very briefly at the top left, so I know what the whole thing is going to look like. So it's going to be revenue, and this is very rough, so it's going to be revenue less cost of sales, and that's going to give me my gross profit. You don't even need, just as long as you can read it roughly, because you're going to write this out again. That's going to be your gross profit, and then you're going to have your interest. You're going to have, all your expenses, and this is going to be the biggest part on the sheet, expenses, boom, 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 boom. So gross profit less your total expenses is going to be your EBIT, your earnings before interest and tax, and then you're going to do less your interest, and that's going to be your profit before tax, PBT, and then you're going to have your tax, and then your profit before tax less your tax is going to be your profit after tax, or your PAT, and then your profit after tax is going to really be your profit for the year. And then what you can do is that you can do, if you have any dividends, you can put that over here, and then your profit after tax, profit for the year less dividends, and that's going to be your reinvested profits. Okay, so that's just a rough sketch. Now I'm going to write that out in full. So I'm going to have revenue right at the top here. Okay, pound, and then I'm going to have cost of sales. And that's going to be the cost associated with generating that revenue. All right. So that less that is going to give me my gross profit. Okay, which I'm going to write over here. And that's an important number. And then I'm going to have all my expenses. And that's going to be boom, 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 boom. This is going to form the majority of the income statement. And then the total of that, I'm going to subtract from the gross profit, and that's going to give me, what's that going to give me? It's going to give me my earnings before interest and tax. EBIT. Okay, earnings before interest and tax. Okay, then I'm going to have interest, any interest payments that I'm going to have to make. Earnings before interest and tax less interest. Okay, and that's going to give me, what's that going to give me? That's going to give me my profit before tax. Profit before tax. And then I'm going to have my tax bill over here. I'm going to subtract that, so I put that in brackets. Okay. And that's going to give me my PAT, profit after tax, or profit for the year. And then, this really could go on another statement, but strictly speaking, it could go on this one. Then if we have any dividends, we're going to put that over here. Less dividends, and that's going to give me my reinvested profit. And that will actually ultimately end up going on the balance sheet in the equity position, because that will add to the equity of the company. Right. The other thing to know as well is that the reason we do the cash flow statement and the income statement before the balance sheet is because we need the closing balance on the cash flow, because that will form part of the current assets of cash. Okay, and the reinvested profit, that will go into the equity section under reinvested profit there. So anyway, now that we've constructed the document, we can go through all the different 9 points and we can do it simultaneously. This is the way I really like to do it. This is what's I think a really, really fantastic way to do it. So let's have a look. So the first financial year saw the company issue, number 1, issue 100 ordinary shares with a nominal value of £1 at £1 for cash. So immediately we've got £100 cash in. So we can write down the £100 over there and we can put share issue. Share issue of £100. All right. Share issues will not affect the income statement at all. Okay, because we've only got, again, revenue less cost of sales, expenses, and then everything else is just interest and tax and any dividends we want. So share issue does not feature on the income statement. Also P&L, profit and loss statement. Okay, so number 2, obtain a £50 bank loan at 10% annual interest, loan repayable at the end of 5 years. So immediately I've got £50 more coming in. That's from the bank loan in cash. Bank loan, £50. Nice and easy. At 10% annual interest. So the interest, it should be £5 every year. So that interest payment over here, I can write down immediately £5. Okay. Now remember, everything that goes on the income statement are things that are supposed to happen. It doesn't mean they have happened. It means that you haven't necessarily generated any cash. In fact, this has nothing to do with cash at all. The cash flow is literally just the cash flow. So again, £5 interest, I mean, we don't know if we paid that or not. Maybe we haven't. Maybe we've just forgot to pay it, or we're not going to pay it, whatever. But we should pay it, so that's why it's going to go over here. We don't know if we actually have paid it yet. When we do, that will be a cash out over here. So that's number 2. Obtain a £50 bank loan at 10% annual interest, and we've taken that into account. We've got the £50 cash in the bank, 10%, which is the £5 annual interest that we are supposed to pay, will go in interest over here. The fact that it's repayable at the end of 5 years makes no difference to this at the moment. Now, number 3, pay annual rent for the year of £5. Now, we've paid annual rent for the year of £5, so that's going to go cash out, rent. It's also an expense as well, so we can put rent over here. Rent, £5. Okay. If 0.3 said rent for the year was £5, then it would go on here. It would not go on the cash outflow over here. Okay, we're actually being told two pieces of information here. We're being told that the annual rent has accrued to £5, meaning we're supposed to pay £5, but we actually have paid it because it says pay annual rent for the year of £5. You see, it's a little bit ambiguous. What it should say is paid annual rent for the year of £5. I think it means pay annual rent. It means it actually has paid. If it was to say a little bit more clearer that we should pay £5 for the year in rent, then it would go on the rent expense. It would not go on the cash outflow. Cash outflow means we've actually paid it. So number 3 is a little bit ambiguous, but we'll assume that they mean that we actually did pay the £5. Number 4, buy equipment for £50 cash. Boom, £50 cash. We've got equipment. Paid out £50 for the cash. To be used for 5 years, depreciated straight line. That means that at the end of the 5-year period, it's worth nothing. Over 5 years means that 50 divided by 5 is 10. That it depreciates by £10 every year. Depreciation is an expense. Depreciation, £10 at the end of the year. Again, this is an accruals. Okay, this has got nothing to do with cash. Point 5, buy inventory on credit. Okay, no cash involved, but we bought inventory on credit for £50. By the end of the year, still owe £10. Still owe £10 of that £50, which means that if we bought on account, meaning we haven't paid for it, equipment worth, or no, inventory worth £50, but at the end of the year we still owe £10, that means we must have already paid £40 in cash. So £40 can go over here for inventory. Okay, £40. Buy inventory on credit account for £50. By end of year, still owed £10 of that £50. Number 6, sold on account credit terms for £80. So that's £80 sales. Fantastic. 80% of inventory bought. So we know that we bought for £50. Point number 5 says that buy inventory on credit for £50. If we sold 80% of that, then what was the cost of the goods sold? It wasn't £50, it was only 80% of that, which is £40. So we can say that, cost of goods sold is £40, revenue is £80, which means our gross profit is actually £40. Read that again. Now again, point 6 is the tricky one. If it's going to go wrong, it's going to go wrong here. So sold on account credit terms of £80. Yeah, we've taken that into account. 80% of inventory bought. We've taken that into account because that means that the cost of goods sold is 40. By the end of the year, an account customer still owed £20 of that £80, meaning that they must have paid us £60 in cash. So we put the £60 sales over here. Okay, and I think that is correct. Number 7, paid various expenses totaling £5, all paid in cash. £5 expenses, we'll just say various expenses, and we actually paid for that in cash. So that would be £5 various expenses, £5. Paid bank loan interest of £5. So remember we had here our interest £5. Now we know another piece of information. We actually paid for it in cash. So we'll put here cash outflow, £5, bank loan. And calculated tax bill is £3. So we'll put the £3 tax bill here. We didn't pay for it, so it's not going to go on any cash flow statement as outflow because we didn't pay for it yet. It will go on a statement of financial position on the balance sheet as a tax liability. It'll be under a liability, but not on here. Just £3 tax. Okay. took no salary but withdrew £10 in cash dividends on the last day of the year. So we can put dividends £10 and be very careful because that is a cash outflow. All right, that's something that I missed the first time. Dividends, £10 outflow. Okay, and that should be 0.129. So now we can calculate everything. So let's get our calculator out. So let's do the cash flow statement first. So we've got 100 plus 50 plus 60 gives you 210. So we'll put the 210 over here, the line underneath, okay? That's the individual cash inflows, and the column to the right is the sum. So we can see easily £210 is the sum of cash inflows. Cash outflows, let's sum that. So we've got 5 plus 50 plus 40 plus 5 plus 5 plus 10 gives us 115. Okay, and we'll put a bracket around that to indicate that we need to subtract that from 210. So 210 minus 115 is, I guess, 95. 210 minus 115, yeah, 95. So we'll put 95 in over here. That's our net cash flow. Opening balance was 0 because it's our first year of trading. So if we add our net cash flow to our opening balance, that will give us our closing balance, £95. And that will have to go onto the statement of financial position under the asset section in cash. That'll be our current assets in cash over here, okay? So that's why the cash flow statement is important. Now moving on to the income statement. So 80 minus 40 is 40, gross profit. Expenses, 5 plus 5 plus 10 is 20. Well, that would actually go over here, £20. So 40 minus 20 gives us £20. Is that correct? Gross profit minus our total expenses gives us our earnings before interest and tax. Yes. Minus our interest payment, £5. So that gives us £15. Profit before tax, our PBT. Minus our tax figure, which is 3, gives us 12, which is our profit after tax, or profit for the year. Minus our dividends, £10. So that leaves us with £2 reinvested profit, and that will go on the statement of financial position under equity for reinvested profit. So that's this example completed, and those figures have been checked and they are correct. So got £95 closing balance and a £2 reinvested profit.